Hi, I'm Wayne Blanchard. I'm a certified financial planner and a member of the Garrett Planning Network. We're going to discuss today the role of deposit insurance. What we're talking about is deposit insurance is what the FDIC does, say for the banks. They insure your deposits in the local banks. Now, why is it that they do that? Is it just because the government loves you and wants to back up your deposits? Or is there maybe something that's a little bit more to it than that? Well, it really, even though they do want to protect your interest, they do want to protect the whole interest of the entire economy also. Let's take a situation where either a bank fails or there's a run on the bank. Either way, we've got could have a real jolt to the system. So because what really happens? Let's think about a situation where, for example, we have a run on the bank. Now, what that means is, like it had in the Depression, people were worried that the banks were going to fail and their money was not protected. Well, what would you do? You go to the bank and say, I want my money right now. So they did. And that was a very difficult situation. So the government said, they came out with deposit insurance to protect you from having to worry about that. But let's say it isn't there, then what can happen? Well, what starts to happen is a chain reaction because they give you your money. Now, you've got to think about the fact that what does a bank really do with your money once you put it in there? Because you aren't just giving it to them for safekeeping. They take the money that you put on deposit with them, and they loan it out to other people. That's the business of a bank. Now, when you come and get your money out of the bank, they have to start calling in those loans. So let's say there's a bakery in town and they have a loan with the bank, and basically you came in, got all your money out, you and all your friends. So what do they have to do? They have to call the bakery, and the baker say, listen, we don't have any more money here, so you have to pay off your loan right now. And the baker says, I can't pay off my loan right now. And so the banker says, well, you've got to give me your bakery. And so they say, okay, and what does that mean? Well, that means that all the employees of the bakery have to be laid off. And what does that mean? Well, now those people that used to be working and were out buying goods and services in the community can no longer do that. So the butcher no longer has anybody buying his meat. So what happens to the butcher? The butcher goes out of business. So what happens when the butcher goes out of business? His employees, and you can see how the thing just goes on and on and on. So the real purpose of deposit insurance is to soften any kind of an economic blow, to give the system a little time to recover. Now, if it's one bank that failed, not a problem, because the FDIC can step in and take it over and transfer those assets around and you're okay. It's where there's a bigger problem is if they need a little time to reset the banking system and make some things happen so it doesn't ripple through the economy and really make it have big problems. And that's what kind of almost happened back in 2008, and that's why they had this big bank bailout that you heard about. So we have to be real careful about that, and that all kind of comes around to why and what deposit insurance really does.